think it's going to be a monetarily based bull market for gold. I simplify the argument that if you like gold, and you should, then you have to love silver, because silver always follows gold higher in a monetarily based bull market environment, which we have directly ahead of us. I really discount the industrial demand story for silver. I recognize that solar is a special case and may create some supply constraints on silver going forward, but silver would be far less valuable, priced far lower today if it wasn't for its use as money or as a monetary metal. And that's where the bulk of its value lies. Industrial demand is not that great of an impact on the metal. 70% or more of silver production is as a byproduct of other metal production. Very few pure silver or primarily silver mines or production sources out there. So it is money that drives silver's use as money, historical use as money, that drives the price. So I don't see a recessionary slowdown in industrial demand. If that's accompanied by the kind of policy prescriptions we're likely to see in that environment from the Federal Reserve and other central banks, then I think that's going to be very positive for silver. Typically and historically, gold performs well during Fed rate hike cycles. That seems a bit counterintuitive, but the record is clear. And in fact, it had started a brief rally in anticipation of the Fed rate hikes. And gold is not the perfect inflation hedge because it doesn't follow the CPI tick by tick. But what it does do is reacts when people really get freaked out about what's going to happen to the purchasing power of their currency. When that happens, people rush to gold, and gold makes up for lost time and really overshoots what would be an equilibrium level. I'm fairly confident that's what we're going to see over the next few years. One or two episodes like that where we get this really kind of hyperbolic spike in the gold price as people truly become concerned about what's going to happen. And when that happens, then silver is going to follow. Then mining stocks are going to, absent any kind of a situation like we had in 2008 when people were really they were really worried about having anything in paper. Absent that kind of a frenzy, the mining stocks will follow gold higher and leverage those returns. So I think that's another area that's really a great one to get into now to kind of hedge against these macro issues we see coming up. There's a lot of noise put into the signal that is historically as being unable to raise rates in an inflationary environment. How bullish that will be for precious metals. In fact, that will be something that can kind of separate the precious metals from, say, equities and bonds and the like, which have benefited from this ever easier monetary policy and have traded in correlation with gold as everything else has, driven by easy money central bank policies. If the Fed is, if we're in an inflationary environment, the Fed cannot raise rates, then that is something that is somewhat destructive to bonds and to equities. But it is very bullish for precious metals. So it is one of the scenarios going forward that would be, very, very positive for precious metals and associated investments and tangible assets in general. Positive for gold. And we kind of suffered along. Right now, we're in a position where gold looks like a lot of pressures are going to start to come on the Fed to, if not actually pivot, then at least take its foot off the gas on the rate hike situation. I mean, we've been in this business a long time. We know we can't pinpoint the exact bottom, but we can look at things and say that's a good value. This is a bottoming formation, or this is a buying area in terms of price. And I think that's where we are in terms of all of these metals and the associated mining stocks. There are a lot of companies out there. There are a lot of great projects that are, they're on the clearance rack right now. and they may be lower, they may be cheaper at some point in the future, but they shouldn't be a whole lot cheaper. And the upside potential is exciting. There are companies now that are selling for a third or quarter of where they were selling in, not a rollicking bull market, but just in a normalized market. And you can pick these things up and get that kind of 3 to 4x potential betting on just a market normalization, not the kind of really bullish market that we're anticipating. So that's a great risk reward scenario. So I think it's a great time to find those kinds of companies over now and over the next few months and just peck away at that policy. For gold and silver, you've got really an incredible monetary story, fundamental story for higher prices. But if you get beyond gold and silver into the base metals and other commodities, you have a lot of other stories out there that seem to make it inevitable that we're going to see much higher prices. You have the whole EV revolution and electrification and the reshaping of our electric grid, the battery metals that will be necessary. And supplies just aren't there to meet those demands. So I think we're going to enter a golden age, no pun intended, for not just gold and silver, but commodities in general and tangible assets, because I don't see any way that we can get inflation down to 2% or anywhere near there over the long term. And I think we're going to have negative real rates and have to have negative real rates basically forever going forward. And in fact, Fed policy is driving all the markets and has driven all the markets, I guess, increasingly so since 2008. But it's really a cycle that began with Volcker when he started to lower rates again after killing off inflation. We've seen a progress in the market, 40+ year bull market in bonds, but also a 40+ year success of successively lower interest rates, of the Fed lowering interest rates in response to any kind of a slowdown in the economy, and then failing to really normalize rates or get them past the midpoint of the previous range. So it's been a stair-step pattern, ever lower on interest rates until we're bouncing around along zero now. And the record shows that at some point the Fed's going to have to return to zero, because the markets, all of the markets, are addicted to this easy money. They're not addicted to easy money, but they're addicted to ever easier money. So whatever the Fed does to get us out of the next crisis, which it will, which is coming at some point, they're going to have to do more than they ever did before. They're going to have to be much more dramatic, much more to a greater degree, and much more quickly than they did before.